Misconceptions about modern banking. Hey guys, welcome back to our channel Fortune Focus. In today's video, we will talk about the misconceptions about modern banking. Are you excited? If so, then smash the subscribe button now to never miss out on more videos we post. Modern banking has been a topic of interest in recent times. However, not everyone can understand the concept of modern banking, mostly because people are not taught about it, and hence the misconception remains to build up. Indeed, even though managing an account framework is tremendously critical to both our funds and the more extensive economy, most individuals still have a restricted understanding of how it works. That's decently unavoidable. The cutting-edge keeping money framework is so complicated that indeed numerous investors don't completely get it. But it is at the slightest conceivable to clear up a few broadly held misconceptions. Number 3. Interest rates are decided by the central banks. Since the media regularly alludes to the government raising or bringing down interest rates, it is simple to accept that central banks have added up control over them. But this isn't genuine. Interest rates are essentially the cost of money, and like all costs, they are eventually decided by the free advertising. Indeed, on a worldwide level, central banks can set the least interest rate on managing an account institution that can create credits. The banks beneath the framework are not liable to any commitment, and they form credits at a minimum rate. This is often precisely what happened within the 2008 credit crunch, when, in essential terms, significant banks were so apprehensive around their balance sheets that they refused to create modern credits. Indeed, even though the government say it brought down the short-term lease rate to approach zero. The entire thing leads to a deficiency of accessible credit around the world, severely harming financial action. The central bank will too set targets for the standard rate of interest and attempt to meet them over time, for illustration, by altering interest rates on the money it loans to commercial banks. Even on a universal level, central banks have much less control over interest rates than most think. Nations frequently look to raise cash through many government bonds, the interest rate on which is set by the central bank, as well as a rate, and no one needs to purchase the bonds. So a central bank must alter to advertise requests, both broadly and internationally, when it comes to interest rates. Number 2. The common notion that the central banks are the ultimate decision maker. The American Federal Reserve Act can offer assistance to scatter the myth that central banks are all powerful. It's genuine that the act awards the central bank a few lovely noteworthy powers, but what's lost from the more critical act is lost. First of all, the government save, or any other central bank, has no control over credit rating organizations such as Moody's or Standard, which decide the financial soundness of whole nations and can wreak destruction on any economy. Besides, no central bank has any control over the shadow banking system. This incorporates substances such as fenced stores and imperial riches reserves, which may act like banks, but are not subject to the exact directions. Moreover, the existence of megabanks like Citigroup, HSBC, and Goldman Sachs work around the world, meaning that they are subject to specific directions from totally different nations and can utilize this to their advantage. The previously mentioned teachers control trillions of dollars and are not responsible to the citizens, other than those who take their assistance. So to say that a central bank can control an entire economy could be a net oversimplification. Number 1. The misconception that banks control the rates of interest. The credit rating organizations have as much impact on interest rates. That isn't more than any central bank. The word of one of the 3 significant offices can make or break a whole economy. Their evaluations decide the toll of credits to nations, states, and territories inside those nations, personal cities, major corporations, and indeed people. The primary thing a bank does is that it works to issue an advance to see at the applicant's credit rating to decide whether making the advance may be a secure thought. The lower a rating from an organization, the more it costs to procure credit, and the harder it is for the borrower to pay off the gathered obligation. This horrendous obligation winding has demolished more than one nation within the past, and like several major organizations with around-the-world reach, credit rating organizations are subject to both debasement and slips in judgment. After the monetary emergency of 2008, calls have been made to discover an election to the organizations due to the crazy sum of control they hold with no responsibility to the public. We will know if any significant changes are implemented in the future, but this can certainly be one range of the monetary framework that's in high demand and requires an overhaul. We hope this has helped you to clear out your misconceptions. That's all with the video. Let us know in the comments section if there are some more misconceptions about modern banking that the world needs to know. We hope you enjoyed watching. Until the next video, stay tuned and subscribe for more.